Okay, everybody, welcome along to our mortgage guidance for buyers and switchers presentation. Part of our winter series webinar for 2025. I'll introduce myself and my colleague Ryan now in a second or two, but really what we're going to try and go through today is just to give first-time buyers, movers or switchers, just an understanding of, how the process works from a mortgage application perspective, and I suppose what your options are, what you can do, what's possible, what's not possible. And I'm not an expert in this field, so I am a certified financial planner, but my colleague Ryan is an expert in that field, and Ryan will be taking us through each and one of those options today. I'll be handing over to him after this slide. You'll be happy to know. But just to introduce myself, my name is Colin Whelan. I'm a certified financial planner. I've been with IPF for roughly 11 years now, and I work on the financial planning side of the house. But from a financial planning perspective, what I suppose we'd like to be able to provide our clients with, or even anybody who is looking down the mortgage road, is a good mortgage advice. We want to be able to give you guys, a service from all different aspects of financial planning perspective. And as I said, I'm not an expert in that field, but my colleague Ryan Flood, who's been with the company just around roughly 1 year now, Ryan is going to take us through that aspect of, of the mortgage process, etc., etc. For those of you who aren't aware of who Irish Pensions and Finance are, we've been around since roughly about 1993. As things stand, we manage roughly 1.2 billion euros of client monies, and we're delighted to say that. That's grown, that's doubled over the last number of years. Last 5 or 6 years, that's actually doubled. And that's through good management and through actually putting our clients first. And that's really, really important. And I suppose that's where this webinar is born out of, trying to put our clients first. Um, I suppose some of you may know us because we run payroll facilitated ABC schemes. ABC is additional voluntary contribution scheme for public sector workers, a pension product. And that is our staple product. But as I said, we are financial planners and we do offer add-on services on top of the ABC scheme. Once again, we have a dedicated team of financial advisors who are experts in public sector benefits. Something I'm really proud of. Again, we try to be absolutely top of our game when it comes to this area, this field. In saying that, we have a number of private sector clients as well, and we are experts in that field as well. We are, as I said, we try to have dedicated financial advisors, and we have to educate our financial advisors to get to the highest possible educated level within our field. I already mentioned that we have over 1.2 billion euro worth of funds under management, but we're delighted also to say that we have over 30,000 clients as well. And luckily enough, since we ran our Trustpilot, we have over 415 reviews. And you can see there, it's just a few reviews from the mortgage side of things. Okay, so just to kick on a small bit here, hopefully this is going to be roughly about half an hour. I am going to leave the chat function open. So if you do have any questions, please use that chat function. I'll be keeping an eye on it. So I'll be doing a bit of seeing, I suppose, as we go through this. I have a few questions that I think I'll be able to ask on your behalf as well that will help things out or help you guys to understand a little bit more about the mortgage process. But please, if you have any questions yourselves, feel free to ask them. I'll try and ask Ryan as many questions as possible. Just so to help you guys as much as possible. We're also running a competition, so there will be a voucher on offer, so €100 one for all voucher. So listen carefully. There will be a question on the information that we go through. So keep those ears open. And the other thing is that you'll notice here on this slide that we have a barcode in the top right hand corner. And this barcode, I say barcode every time I say barcode, I just feel like an old man when I say that. Is a QR code, not a barcode, as my daughter will remind me numerous times. But that QR code is essentially if you guys feel or something takes your ear and you want to actually go further with ourselves, then you can actually fill out the details that are attached to that QR code. And I'll bring Ryan in here. So Ryan, I suppose, why would a person, click on the QR code, if that makes sense?
A number of different reasons. So the main thing of the webinar is kind of a generic overview, and then obviously the consults themselves will be specific to that particular person or couple. So we'll go through mortgage ready. So that's when someone plans to start looking to buy a house, let's say mid next year. So we put a plan in place now so that in 6 months' time when they apply, they're ready. And the application has kind of the best chance to go through because we have put the plan in place. We can go through different options in terms of what the rates are at the moment for switchers, or kind of go through whatever your plans are. So like what the advisors do is an annual review with clients, then they pass them over to me so I can go through the mortgage side of things and help them either reduce payments, overall cost of interest, and whatever is in their goals to proceed.
Okay, cool. So a number of reasons why that QR code might actually be something that somebody wants to actually click on into.
Yeah.
I think as we go through, so I'm going to hand over to Ryan fully now, guys. And Ryan's just going to go through a bit of an agenda and he's going to take the reins from there. So Ryan, I'll hand over to you and I'll try and make you the host as well.
Perfect. Thanks for that, Colin. So just a quick agenda, basically just kind of a step-by-step guide in terms of what we're going to discuss today. So why choose a mortgage broker will be the first thing. Mortgage types, documents required, rules and fees just in relation to the applications themselves, how the journey will actually look for each and every scenario. Do's and don'ts, just a couple of small tips in terms of account management. We'll do the prize draw then at the end. So we'll ask the question, then we'll go through it, and then we'll go through what happens next then at the end. So the main thing is to why public sector, choose IPF, and why we kind of pick the mortgage broker essentially. Sorry, my access isn't working. So the main points, Colin, can you?
Click on.
Yeah.
Technology is great when it works.
I'll keep going while Colin fixes that in the background. So essentially, one of the reasons why public sector choose IPF is that we've been working in the public sector since 1993. Number of different clients, so over 30,000 in the client bank. So like we understand the public sector, we understand how it works, what the deductions noted on your payslips relate to, how your income is broken up, whether you're guard, nurse, ambulance, firefighter. It's a bit messy when it comes to that in terms of all the allowances. Then obviously you have your Department of Defence with Defence Forces, but then you have everyone else in between. And then on the private sector side of things, we look after as well, because not everybody works public sector. We understand how your salary scale works, so in terms of your increments on an annual basis, pay restorations in between, and how your role actually in the public sector can progress, whether you're going from an executive officer to higher exec, whether you're going nurse, staff nurse, and so on. So it's just ensuring that we understand your particular role in the public sector.
Just on that point then, Ryan, so I was like, that's important for public sector workers. It's a little bit different to private sector workers because I suppose it helps us to allow for get more, I suppose, more money for more of a loan, I suppose, way of putting it, for that particular person if we're able to see that they're able to go up a salary scale. Would that make sense?
Yeah. So on your salary scale, you'll go up certain points in certain times. So every 12 months, you'll go up an increment and then you'll get your long service then towards the end. So lenders will take your salary up that scale. In terms of additional allowances then as well, each lender has their own different breakdown of what they accept. So I'll go through that with whomever I'm with and break down how their income's going to work and utilize as much of that income as possible, which will in turn allow you to borrow more, which could, in this current market, help you get the house you're looking for.
Yeah, exactly. A great point. I think it's really important to just understand whether you need that little bit of is. There might be something there that actually we can help you with in that regard.
Perfect. So the first time buyers is essentially the big one, which is the majority of people because they're new to this particular product. So a couple of breakdown points is that first time buyers, I generally recommend getting in touch 6 months before you apply, again, just to put the application in place. But some people could be mortgage ready now, so that 6 months doesn't actually come into it. So it's important to have a chat to see where you're at, what current position you're in, and go through what your plans are, what your goals are, because they could be achievable. Or at the very least, you'll understand where you can kind of go. What they'll do is they'll take 4 times your combined salary if it's a joint application, or just 4 times of your sole. Overtimes can be accepted, so your guards, your nurses, and so on. With the deposit, it's a minimum 10% deposit, so it can be made up in a number of different ways, whether it's through savings, government schemes, gifts, and so on. The schemes available will be Help to Buy, which is essentially a tax refund going off your last 4 years of income earned in the Republic of Ireland, and it's per calendar year, so you won't get the benefit of the earnings you've earned this year until January. So you can apply, see what you qualify for there. No obligation to take it, and it will expire at the end of this calendar year. You have your first home equity scheme, so that's when you give a portion of the property's equity to the local authority. You repay it within a certain period. Fees do come into it then as well. but it is repayable. And then you have the affordable homes. So what the affordable homes is where you get a discount on a new build development. You can use Help to Buy in conjunction with both of those. And it's just another way of getting yourself onto the property ladder. There are
But
cashback
you can
offers.
have, I'm cutting across you, my apologies. And you said,
Sorry.
like, I suppose just one thing there, like you can help people with that. Like if people want to get a better understanding of how that works, if they qualify for that, you'll be able to take people through that.
Yeah, so I'll be able to show them what the scheme is, how it works for them, and
Yeah.
what options they have with the scheme. Now, it doesn't always work for certain people because they might not want to buy a new build. They might not want to live in an estate.
Yeah.
They
Yeah.
might want a property on their own. So it's about just kind of exploring all options and
Yeah,
seeing what's
understanding,
available.
honest. I mean, that's the crucial part about like planning for anything. It's about having options. The more options you have available to yourself, the better, the better, I suppose, the situation you could find yourself in. So I suppose that's where you come in, being able to actually talk people through what their options are, what they can use, what they can't use, and then they can make an educated decision as to whether or not what's in their best interest.
Exactly. So it's like a little educational piece at the same time. And if you
Yeah,
can understand the mortgage better, it just makes the process itself less stressful because I'm sure you know a few horror stories when it comes to mortgages, stress, and everything in between. With lenders, they'll offer cashback offerings as well. So like if you get a mortgage with a certain provider on a certain rate, they'll give you a bit of cashback to help. So you can use that cashback for whatever you like, whether it's reimbursing your savings because you've used the majority of them to buy the house, do small cosmetic works to the house, or go on a holiday after go through a mortgage application. And then you have the option of either fixed variable rates or a bit of both. So just a couple of
a
quick,
nice holiday.
yeah, depends where you go.
Yeah, yeah, give the
Um,
front room, go on holiday. Yeah, absolutely.
Exactly. So just a quick calculation then in terms of your mortgage. So someone earning 35K and someone earning 32 and a half, it's a combined 67 and a half. And then 4 times that is 270. So in that particular scenario, minimum purchase price will be 300,000, 30,000 deposit plus fees. And in that scenario, if you go down the cashback route, you can get up to 5,400 in cashback.
Okay.
So nice little
So in all
holiday.
seriousness, like I'm not talking about holidays or like all that type of stuff, but that is crucial. Like I think I've used that myself from the point of view of actually switching mortgage. I know you're going to get to that slide, and I'll maybe hold that story for them, but like it is so useful when it comes to like solicitor fees, like paying off surveyor fees, like for more serious things than going on holiday or doing up the front room. It is really, really helpful, I suppose, and that's something that that's something you'll be able to take people through, I suppose. Yeah.
Yeah, so like one of the most common things that clients do is they just use that to pay the first 2 or 3 months of the mortgage. So they don't have to
Okay.
worry about it because when you move into a house, you're going to have additional spending. You're going to be
Okay.
buying furnishings, all that sort of stuff. So like if you don't have to worry about paying your mortgage for a couple of months, anybody
Yeah,
will
it really
take you up on that.
helps. Yeah, it
Yeah.
really helps. Yeah.
Moving on to second time buyers. So it's more or less very similar to a first time buyer, but there are some restrictions then. So like you can only go 3.5 times your salary. You can
Okay.
still go up to the 90% loan to value. So that means a 10% deposit. You can put more. So most people for second time buyers would fund that through savings, gift, or selling the old property and using whatever funds coming from that sale to buy. And you can do that in kind of like a chain transaction. So you can sell and buy very close or at the same time. You can just line them both up. You can use the equity release for the new purchase, retain your existing property. So like if you have the savings there to cover the deposit, and you want to keep an apartment or a house rented out, build up a second income, then you have that option as well. Cashback options are available on this side of things as well. And generally with second home buyers, it's either a trade up or a trade down. So like whether you're looking to move into your family home for the rest of your life, your dream home, or whether you're looking to trade down, a lot of people generally move to the countryside closer to retirement. So depends on the scenario, but it's always important to kind of go through the options on it.
Okay, cool. So like one of the big difference I noticed from that slide then is like if you're a first time buyer, you can, 4 times your salary is allowable. Your second time buyer is 3 times salary. Anything else that kind of stands out there?
There's not much that stands out because the only other restriction then on second home buyers really would be the schemes available. So you don't have access to Help to Buy, first
Yeah,
home
okay.
scheme and all of that. But at that
Yeah.
second stage, like you've already had a property before, so there is a possibility there's equity built up or a bit
Yeah.
more savings if
Yeah.
you're on
The
the
equity
older
is a
side.
big thing. Yeah, yeah. Very good.
Exactly.
Yeah. Okay, cool. Very good.
Yep. So we'll move on to switching. So switching is one of those things that either works or it doesn't. So the main point on this is essentially just to go through all the options on it and see if it is something that's kind of working for you, depending on what your scenario is. So you have the one mortgage. So if you wanted to switch your mortgage, just guarantee your payments, not have to worry about the turmoil of rates going up and down like they have over the last number of years. You have that option available to you. So you just lock in for one rate for the rest of your mortgage and you never have to think about it again. you can switch to reduce your interest. So like cheaper repayments on the mortgage itself. Cashback options are available here as well. And what they're mainly used for is to cover the cost of switching. So legal fees and evaluation. So you can kind of cover that cost so it doesn't actually cost you anything. If you want to reduce your term or interest costs, so like let's say you're 5 years into your mortgage and you want to switch, you have a bit extra per month to make repayments if you want to overpay to reduce the interest, or if you want to switch, reduce the term and just finish the mortgage sooner, but increase your repayments slightly in between.
I think it's important on that point though, like to talk to like your financial planner and talk to them what is the best use of money there, because it could be a case you got different goals, different different objectives, and you might
Yeah.
be able to use that money in like, don't get me wrong, like paying off the mortgage early, absolutely efficient, but there might be a more efficient way of using that money, and that's why it's important to engage with your financial advisor in that area, I suppose. Just on that,
Yeah.
like I actually, so just for everyone attending, I did switch my mortgage. I switched over to PTSB, and what I was able to do was I took a look at like non-cashback options, one, because the interest rate was lower with non-cashback options, and then I took a look at also with cashback options. And I switched across for 3 years. I did a 3-year fixed rate, and when I looked at with the cashback, with the repayments of the higher amount on the higher interest rate, and also with the help of with our mortgage expert, I was able to see that actually it made more sense for me to go on the higher interest rate for those 3 years and take the cash back, because I'm actually going to work out financially better. And then I'm coming towards the end of that fixed rate. What I'll be doing is I'll be looking to switch again. I'll be looking to see what options are out there to try and take advantage of the different lenders benefits. But that worked out great for me, I must say. Like, and you'd be surprised. You'd think to yourself, "Oh, I'll take the lower interest rate because it makes more sense." It actually didn't, and I think that's where the advice comes into play.
Yeah, it's always like, I know a lot of the advisors here use the term vehicle. Again, it works here as well. Like a mortgage is essentially a vehicle as well. If you're putting
Yeah.
your money into your mortgage, you're reducing the costs. But it depends. Like if you're doing it on a monthly basis, generally the mortgage is a better choice. But if you're doing lump sums, it's always better to make sure that money is working for you, because
Okay.
once you put it into the property, you can't get it until you sell. And
Yeah.
that's unless you do this next option where you're releasing equity. So like if
Okay.
you're looking to release equity, then you might be looking to build an extension, family's getting bigger, want to build a home office. If you have loans that you took out to do works on the property, you want to get your money back. All different options are available on equity releases. But one of the most common is consolidating home improvement loans, releasing money for medical expenses, education, that sort of thing. So it's all about just kind of putting repayments into one and making the month to month a bit easier then as well.
Okay. Very good.
And then that's just a quick example. So if your house is valued at 400,000, you have a mortgage of 200 left on it after a number of years of paying it off, you've technically 200,000 in equity based on that current value. You can release up to 120 in that particular scenario. So
Okay.
kind of going through all the different options of switching, like of a case active at the moment, which I find is going to become more common. So it's where someone's on an extremely high interest rate. So in this particular case, it's 4.9%. Repayments of quite high, about 1769. So like if they switch now, they're going to get hit with a breakage fee. So breakage fee is just shy of 5,000. So normally when you're having a conversation with someone, it's quite expensive. But with similar to yourself, with using the cashback, like the cashback on this particular mortgage is 7,000.
Okay.
You can use that cashback to cover the breakage fee, cover your legal fees and expenses. So it's not actually costing you anything. It's a little bit of work to do the application itself. But again, we do a lot of heavy lifting, and you're going to be saving yourself €190 a month.
Yeah.
And it's
That's a
actually not
no-brainer,
going to
isn't it?
cost you anything. It's a combination of a number of those things. It's cheaper repayments, you're reducing your interest, you're paying like nearly 4,000 less in interest over a year alone.
That's a holiday. I go back to a holiday.
Yeah,
You
we
tell me
all
we
need
go
a
on a
holiday
holiday.
after this,
Yeah, yeah.
especially coming
But
up to
like,
Christmas.
yeah, that's gas though, isn't it? Because I do, and you mentioned like the mortgage like process. I think we're going to go on to like the next slide now. You happy for me to go to the next slide?
Yeah, yeah.
Yeah, and like you mentioned like about the mortgage process, and like some people think like, well, people do think it can be a little bit cumbersome and a little bit, that there's a lot of stuff to do.
Yeah.
But I do think we have worked on our process to try and make this as like streamlined as possible and help as much as possible for our customers. But I do have to, there is still a bit of work to be done. But I think if I said to you, look, I'll give you $4,000 to go and get all these documents, what would you say?
Yeah, you'd say, yeah.
So it's gas, isn't it really?
Yeah.
So I think if it makes sense financially, like there's a massive like, there's a massive motivator to go and get this bit sorted, but you won't know, I suppose, talking to the people who are actually on the presentation, you won't know until you actually look into that. And when I looked into it, I was able to find that it made a lot of sense for me to do my switch. Not only was I saving on the actual switch itself, but also I was going to get cash back, and that cash back came in very, very handy. I was able to use it to my advantage.
Yeah. Like the other thing as well, like on the switching side of things, it might not make
Mm.
sense. So you might have been lucky to lock into a short-term fixed rate. So the
Sure.
advice in that scenario is stay in it as long as you can. But what you should be doing then is preparing for an increase. So like a lot of people will be fixed on like something like 2.5, 2.7. You're not going to get a rate that low. So like, do
Yeah.
you know yourself if you can afford an uplift in your repayments? So that's another thing to consider. Like, yes, it's great being on a low fixed rate, but it does come to an end after a period of time.
Okay. A decision needs to be made, and also if you prep for that decision, it's going to be very helpful as well when you're getting that.
Exactly. So like I can give you an idea of what that payment's going to go to. So you
Okay.
can start looking at your account to say, okay, can I do it? Or do I have to kind of start changing a few things to make sure I can make the mortgage payment?
So in some situations, it's actually worth changing sooner than the end of the fixed rate, even if there is a breakage fee, even with the story
Yeah.
you described.
Yeah. So that'd be a scenario where you can break out of it. Yes, you're at a
Yeah.
fixed rate, but you can still come out of it if you're willing to pay the difference. And if a lender's going to give you cash back to do it, they're paying for you to switch. So they're
Yeah.
essentially paying to save you nearly 200 a month. And
Yeah.
I can't
Okay,
deny that.
cool. Sorry, I'm cutting across you, but like that makes a lot of sense because I think in certain scenarios it's not going to make sense. In some scenarios it is going to make sense, but really you're not
Yeah.
going to know until you actually kind of, I suppose, like engage
Yeah.
with an
Ask the
expert like
question.
you. Yeah, yeah, fair enough.
That's
Yeah,
the question.
yeah.
Like in
Okay,
terms
cool.
of the process itself, like the documents are
Hmm.
fairly straightforward. It's bank statements, which you can get through e-statements. So just log into your online banking. It's savings accounts, which should be available on that as well. A salary cert, you just get your employer to complete that. Pay slips, which should be in your work emails. Employee detail summary, which is on revenue. Proof of ID and address. Again, everybody should have a driving license or passport for the most cases. And then case-specific documents, so like marriage cert, residency permits, all that sort of stuff comes into it. If you're looking on the switching side, some lenders will have a reduced requirement on that. So like some won't need a salary cert and so on once the mortgage is evident.
Okay.
Move forward.
Right.
So
Yeah.
the mortgage journey itself. So like this is where we try and streamline as much as possible. So what we do is we have an online application form. So we send you a link, you register and you log in. So this is where you can go at your own pace. So not everything's going to be rushed. We move at your pace to make sure you're comfortable and it's easy for you. Once you fill in the application form, the system itself will generate an automated checklist of documents. So based on your inputs, documents will be requested and you can just upload through the portal. So if you have a PDF, just upload it that way. If you don't have it, you can just email it to myself and I'll upload it for you. Once your application is done, we'll schedule a call, then we'll go through the options with all the lenders once I know the actual specifics of your case. And at that stage, then we move forward for approval. So what the approval is called is an approval in principle. So if you're first-time buyer or mover, this is generally what you'll get and you'll use to bid on properties. It's usually valid between 6 to 12 months. Once your approval is there, you find a house, you move on to the valuation stage. So get a valuer for that from that particular lender. They'll go out, check the value of the property, ensure it's in a sellable condition and habitable, and then you move on to your loan offer. If you're looking to switch, you can skip those two processes and go straight to loan offer and then get the valuation done afterwards. Again, it's just covering all aspects. Your loan offer is essentially your legal agreement between the lender and yourself to purchase a particular property for a certain amount. It'll give a breakdown in terms of the costs, conditions, and everything. Once all those conditions have been satisfied, you'll move on to the completion stage, and that's where you draw down. So every application is completely different. Some will move quicker,
Yeah.
some will move slower, some will have specific conditions depending. But again, that's where I come in to help you kind of get through and get everything in order to kind of make it as smooth and streamlined as possible.
Yeah, that's something we, as I said earlier on, that's something we work on very hard, trying to make the actual customer experience as good as possible, if that makes sense. Well, there's a few questions coming in, Ryan. So just one of the questions I have is like, why would someone not go with their bank? Why would they choose to go with someone like us?
So if you go to your bank, yes, they'll have your accounts on file and they'll have a majority of things, but most people always have a second account. So you're gonna have to go get statements regardless, but
Hmm.
you're only gonna ever get offered what they offer. So it's like ringing up your broadband company. They'll only offer you what they can offer. They can't offer what someone else will. And in some cases, another offer is the better offer. Like, so that's where the switching comes into it. If you're going first time buyers, everybody has their own different breakdown. So some will take more income. So
Hmm.
someone will go up 8 points up your scale in a joint scenario, whereas
Yeah.
others, they won't even go up your scale at. whatsoever. So they'll just take your income as it is. And that could be a difference of, let's say, about 10 grand a year in income. And when you're buying a house, that's either 35, 40K in terms of a loan amount, which could bridge the gap to buying the house you want, as opposed to the house you're settling for.
So a few important aspects there. Like you got number one, right, is depending on what lender you go to, you may be actually able to get more of a loan amount. And then
Yep,
secondly, correct me if I'm wrong here, but secondly, then like the better a rate you get, the less you're paying back for that loan. And obviously at the start of any loan, the interest repayments are in comparison to the capital repayments are quite high depending on the loan amount. So the
yep,
better a rate you get, the more money is going to be in your pocket. I mean,
yep,
that's for me, that
exactly.
really stands out for me. Like it's money, it's a waste, like it kind of like it can be a waste of money if it's going into a lender's pocket rather than staying in your own pocket, and all for the sake of actually just shopping around to make sure you get a better the best deal possible, which is exactly what we're able to do for our clients.
Yeah, basically, yeah. Like, who would you prefer to have the money, you or the bank?
Yeah, exactly. Okay, good stuff. There's more questions coming in, so we'll keep on going. We'll keep on getting through this, and the last two questions as we go along, if that's
Sure.
all right.
Yep. So the next one's basically just a breakdown of fees. So switching your mortgage or getting a mortgage, there are going to be fees involved. So you're going to have your valuation fee, which can range between 150 to 200. Legal fees, about 1800 to two and a half. Could be higher, could be lower, depends on what you're actually doing. And you're going to have your stamp duty cost. So that will be 1% of the property value up to 1 million. After you go over the million mark, it's a good problem to have, but it just does get a different breakdown. And then a structural survey. So between 3 to 500, again, can go up, can go down. It's not mandatory unless the lender requests it, but it's generally recommended because you don't want to buy a house that's structurally defective without your knowledge anyway. You
Hmm.
might be willing to buy it and then do work, so that's fine. But the last thing you want to do is have a large bill in 2, 3, 4 years' time when a wall starts falling over. And then any other fees, so like application fees, additional costs essentially for you will be broken down based on your particular scenario at the application stage. So like
Hmm.
someone like a first-time buyer will have a fee. If you're looking to do a rental purchase, different fees break in there. So I won't bore you with all the numbers.
Yeah, okay. But like there is fees for certain types of mortgages. We just want to get that across and be completely clear. And we will
Yeah,
be completely
and
upfront about that at the outset of any consultation.
yeah, and throughout the mortgage on your loan offer, it'll have a full breakdown of the cost of the fees as well.
Yeah.
So
Okay,
everything
good
will be
stuff.
broken down.
Okay, fair enough. I'm going to go and ask you a question then, right? So it's actually quite a few people just asking, are we going to be sending a recorded video or are we going to send a PowerPoint? We will be sending on, our marketing team will send out a video of this to everybody who registered to attend. Guys, don't worry, that will be on the way. So I'm just going to pick a different question here.
It'll also be uploaded on the YouTube page as well. And
Okay.
there's other recordings that to be on that as well. So you can pop it off, share it around and stuff like that. If it is
Hmm.
something that either you wanted to attend or you know someone who couldn't attend, you'll be able to just
Sure.
send it on.
I have one person here, and says her partner, sorry, he or she says their partner is self-employed.
Okay.
What additional things would need to be gathered for approval? This person is finding it hard to get solid answers when looking into it.
It depends really. So this is where the QR comes in. So if you're able to kind of pop your details through, but with someone who's self-employed, it depends how long they're self-employed. Most lenders would prefer 2 years, 3 years
Okay.
of them being self-employed. Are they sole trader or limited company? That's what comes into it as well. So if they're sole trader, generally it's just a breakdown of their business accounts, business balance sheet, profit and loss, all that sort of stuff. But they'll also need their self-assessments. So Form 11 and Chapter 4 is what they're called. So the ones you send into revenue, usually around the end of October or up to about now, if you're
Hmm.
using the online system. If you've recently gone self-employed, so someone like a doctor or like an advisor, like a financial
Yeah.
advisor, consultant, that sort of thing, you might only be self-employed a year. But depending on what kind of your income looks like, you can still apply for a mortgage with some lenders, even with just a year, if you've gone from PAYE to self-employed in the same industry. So like your
Okay.
doctor to GP is a common one. Dentist would be the same, IT consultants, stuff like that, where they'd go down the self-employed route rather than lose a year where properties are going up 7% every year. You could save
Sure.
yourself 30, 40K in buying the house now as opposed to waiting.
Okay. So very dependent on occupation there. So once again,
It's
this
pure.
is like, yeah, it's very specific, isn't it, really?
Yeah.
Okay, cool. So I'll move on to the next slide.
Yeah.
Excuse me.
So additional expenses. So with a mortgage, there's going to be unique scenarios, but unique products that you need to take out. So one of them is going to be mortgage protection or life cover. It's essentially cover on yourself or yourselves, depending if it's sole or joint, where if one or both were to pass away, the mortgage gets cleared. So it's cover on the loan as opposed to cover on yourself. So that's kind of an important thing, but it is decreasing term, which means it's a bit cheaper. So you're probably looking between 20 to 40 per month on that, but it is health related. So any underlying conditions, obviously we'll have a chat on to break it down. Your home insurance then, so that's mandatory if you're buying a house. If you're going down the apartment route, then it's not. But you have to cover the cost, what's called the reinstatement value or the rebuild value. So how much it's going to cost to rebuild the property. And the bank or the lender has to be noted on that policy. Contents insurance, not mandatory, but generally recommended because a lot of people kind of don't value their goods, but they're worth something, whether it's value or sentiment. So you want to make sure they're covered, and it's fairly cheap as well, especially when you're considering an apartment where you don't need home insurance. You want to make sure you have some level of cover. And then the final piece then would be income protection. So I know that's your kind of field of experience. Do you want to expand on that a bit?
Yeah, I'll go back up to the life cover part just for a quick second because the life cover part is quite important because the life cover part can delay the drawdown of monies with mortgages. And so it's really important that the outset of any conversation that like you speak to, your mortgage advisor, Ryan, right, to let them know about any pre-existing health conditions because the last thing we want to see happen is someone's mortgage drawdown, like bidding on a property, whatever it is. And all of a sudden it's delayed because we couldn't get the life cover over the line in time because we're waiting on a doctor's report or information from a specialist. So it's really important that that aspect there is handled correctly. And I think we have experience in that area to be able to help our clients through that. But the income protection side of things, income protection, I mean, look, I have two young children and I have a mortgage. If something happened to my income, there'd be a massive problem for the household. So what I've done, I've put a certain amount of income protection in place to make sure that if I'm unable to work due to illness or injury, that there will be an income coming into the household that's going to cover. Like I'm not going to be like it's not going to cover everything. I'm not going to cover like my full salary, but it's going to cover a chunk of my salary to allow for mortgage repayments, make sure the kids are educated, that type of thing. The really important things in life. As well as that, you get tax relief on this. So the government are willing to actually put their money where their mouth is when it comes to income protection, and they don't want that person to be a lien on the state. If it is the case, they cannot work due to illness or injury. So basically, what the government are doing is incentivizing a person to protect their own income. So, unfortunately, this can be difficult to get if you do have pre-existing health conditions. But we always say to people, look, when you're young, when you're fit, when you're healthy, that's the time to go and take a look at this because it's easier to get and it's cheaper as well. But I'd be absolutely of the opinion that anybody looking to save for a mortgage, get a mortgage, put any sort of financial plan in place, that the foundation of that financial plan is going to be in protecting the asset that is going to allow for that plan to be attained, which is your income. So I'm quite clear on that. I'm going to go back to just some questions here, Ryan, if that's okay.
Sure.
Do you think having a joint bank account will be an advantage when applying for a mortgage as a first-time buyer, or having separate bank accounts? Does that impact the decision anyway? Does it make a difference?
Generally, it doesn't make a difference because they're going to look at every account anyway. Generally, what a joint account does, it means you have to manually transfer money into the account. So if you have direct debits coming out and you don't transfer money in time, it's going to bounce. Doesn't look ideal. Now, if you manage it correctly, then it doesn't make a difference. They're going to look at every single account you hold, your bank account, current account, Revolut, N26, anything like that. So they're going to look at them all. So whether they look at 1 or 10, it doesn't make a difference. Once it's easy to track, because if they have trouble tracking monies in and out, then it just makes it harder for them to put a decision on it.
Okay. I'm just wary of time here, so we might just get through the rest of the slides and then
Sure.
we might come back to the Q&As if people want to hang on after. That's at their own discretion, obviously.
Yeah. So like in terms of do's and don'ts, so again, it's the cliches, but pay your bills on time. No missed direct debits. If you expect direct debits to be an issue timing wise, you can just go on to the provider and change the dates and kind of line it up in and around your salary. Have a set budget to enable you to save. So what we mean by that is that like save a regular amount on your regular basis. If you're saving and you're dipping in, it doesn't look great to the lenders. So they just want to see a consistent amount going in. And then if you have something extra, you can always just put it in at the end. Reduce your credit, including overdrafts. That's an option. You don't have to. And if it comes to the case where one of the loans needs to be cleared in order to get a mortgage, we can condition for everything at the end. So you're not putting yourself out of pocket on a whim waiting for approval. In terms of don't dip into your savings. If you get new credit, again, it's not ideal, but it could still work depending on the numbers on the case. So that'll be case specific in terms of loans and credit cards. If you change jobs, if possible, try and avoid it just because lenders won't let you draw down on a probationary period. With public sector, it's a little bit different because it's the full year is generally what they do. So again, we'll discuss that on a case-by-case basis in terms of options available. And then gambling on your accounts. Again, the odd one here and there won't kill you, but it's a pattern issue that they want to look for.
Okay, so be careful with that.
Yeah.
Okay. Okay, cool. So the next slide is the question, guys. So we said at the start, there's a voucher up for grabs, a €100 voucher. So this next slide is that question. Now, what I'm going to say is, if everyone can just listen to this really quickly, is that the chat function is not going to be used for this. We're going to use the Q&A function. Okay, so if you want to get the Q&A function at the ready, we're going to use the Q&A function for this. So for this to answer this question. Okay, so I'm going to go to the slide in 2 seconds. So not the chat box, the Q&A function. We don't want any confusion. So here's the question. So if you want to go ahead and try and answer that in the Q&A section, I'll keep an eye out.
Yeah. So this will be mainly for your first time or second time buyers.
Okay, cool.
Same answer for both.
Okay, so the answers are flying. Everyone was ready to go. Good, I'm glad to see it. Okay, cool. So what's the answer, Ryan?
90%. So 90% is what you can get on first time buyer or second time buyer. It used to be a bit different, but they've changed obviously recently enough.
Okay. Okay, cool.
And then one of the final points that generally gets asked, that hasn't been asked yet, is in terms of first time buyers and what kind of qualifies you. So people will be under the impression first time buyers is when you've never had a house. There was a change to the definition of a first time buyer. So I don't know if it relates to anybody on the call, but again, it's nice to know that if you've ever got a mortgage with someone, whether you're married or just in a relationship, that relationship no longer going ahead and one moves out and relinquishes their ownership of that property, they will be classed as a first time buyer again. So to get themselves back on the property market, they can use anything a first time buyer can use, whether it's 4 times your income or the schemes available as well.
The nuggets of gold. Okay, very good. So I think people have been waiting, anticipating, just waiting for who has won the voucher. So Keane Piggott. So well done, Keane. You were the quickest hand in the West. So well done, Keane. We'll be in touch to get you your voucher sorted out. So thanks all for it. A lot of people took part in that quiz there, so thank you for that. A quiz, question, Q&A, should I say. So we're on to the last slide here, folks. So Ryan, I'll hand over to you again.
Yeah, so what happens next is generally what I'd say is just scan the code, pop your details in. You put in as much information as you can essentially on your scenario, or what we can do is we can just arrange a quick call and we'll break it down on the phone in terms of what your scenario is. And then we'll either book something in or we'll put a plan in place, follow-ups on a regular basis, just to see how you're kind of going on with the process. And then if you have any unique scenarios you want to kind of pop through, my email is there at the bottom. You can just send your queries to myself or our mortgages mailbox, and then obviously we'll be able to get back to you.
Okay, good stuff. So there's still quite a few people here. So there's quite we're just going to go through some of the questions here that people have actually sent in. So there could be some very valuable information still to get by staying with us. There's a few questions here on life cover I can handle myself. So do you need life cover if you're a single buyer? Yes, you still need life cover if you're a single buyer. Do you have to do a medical for life cover? Not necessarily. It depends on your overall health situation and the level of cover that you're applying for. That's something that we'll be able to guide anyone through. No problem there, absolutely. So I'm just going to take a look here. So just read through the questions here. So just a quick one here. So anonymous attendee, my partner started a job as a primary school teacher this year, but may not be eligible for a permanent contract for 2 years. We're expecting a baby soon and looking to buy. Congratulations on the upcoming birth. Do we have to wait until she has a permanent contract to apply as a couple?
So generally on contract basis, they'd ideally want you to be permanent. That's just what they prefer, but that's not the case for everyone. So with teachers, it's usually 4 one-year rolling contracts. So if she's 2 years away, it means they're on their second contract. So in that scenario, a lender can look at it. Now, they might not go up her scale. That's the only restriction because they're on the contract basis, but they can still accept her income for it. And it'd be the same for any field. Once you're on your second contract and you've shown a continuous employment, then they can look at it. It's not a guarantee, but it's promising.
Okay, cool. Okay, very good. Just a few people who thought about having existing properties, and so I'll read the question. This relation to having existing properties. Can you use your existing properties as collateral for a loan, especially if you have mortgage-free property? But even I suppose that even if it isn't mortgage-free, is it possible to do something in that regard?
There's a few options available. So like you can release equity on that property to fund the deposit on the second one. So it's
Yeah.
technically two mortgage applications because they'll only have one property as the security on one particular loan. They won't have like kind of two properties on one loan, so to speak, on the residential side. So if you want to, you can release equity in one property. You can have cash in your pocket, so then you can go to auctions and stuff like that and just buy with cash. What some people do is they release equity to buy holiday homes abroad. If they're in that scenario, they inherit the property, or they can keep both, rent one out, and have a funding both. But yeah, it's a good
Okay.
question.
Okay, cool. Would we help in making an affordable house bid? Say we have all the documents that you mentioned before. That's something we help with, I think, is it?
Unfortunately, not. So, like the
Okay.
way the affordable homes works, the application has to be made by the person applying. So, if we make the application, we're the one applying. What I can do
Okay.
is I can guide you through it. Like if they're asking for certain documents, we can arrange a call. I'll go through how it works for you. At the
Okay.
moment, we've a couple of dozen cases currently working with the affordable homes piece. So, a few have been accepted. I've seen a few of the arrangements in terms of how they work. So, I can help you where I
Yeah.
can, but it's not a product we offer. So, we can't kind of do the application on that side.
Okay, very good. Okay. But we do help with self-builds. That's another question we have.
Yeah, so self-builds are a bit unique in terms of how they're done. So, generally, they're done in stages. So, it's a long form.
Okay.
So we'll go through how that works, how it breaks down, because every self-build is unique to itself
Yeah.
because you're building your own house.
Okay, cool. That's another question. Like if someone has a subscription to a local GA 50/50 draw account as gamble, is that classified as gambling? I don't think it will be. It's €5 per week.
Uh,
I think that'll be all right.
Small amounts like that is fine because it's
Yeah.
essentially it's a subscription to your local club.
Yeah. Yeah. Exactly. You see the benefit in that.
You're
Absolutely.
financing your local gas club.
Yeah, absolutely. Good to help with the community.
Yeah, it's a good thing
Um,
to do.
Yeah, 100%. There's quite a few people who hung on for the quick Q&A session there. So thanks to everyone who actually joined us, and thanks for those who hung on. As I said, there will be a copy of this presentation sent on to everybody who registered for the presentation. As Ryan said, if you want to actually follow up on any of this, if you're looking at going down the application route, please scan the QR code, not the barcode, and we'll speak to you soon, please, God.